Well, again, welcome everyone. Thank you so much for joining the Montecito Medical Real Estate Fund 4 webinar. Now, without further ado, very short introductions. We like to get right to the point here at Montecito. So in this webinar, we will introduce our newest fund offering, discuss the medical real estate environment and Montecito's unique approach to this sector. As you can see, I have with me our CEO, Chip Conk, and our VP of Capital Markets, Mike Freiberg. Both bring decades of experience partnering with providers like you and our network of investors in raising capital for and running medical real estate funds. So without further ado, I'm going to hand it over to our CEO, Chip Conk.
Hello, everybody. I can't see you guys. I hope you guys can see me, but thank you for your time tonight. I want to thank you guys for your investment, your trust in Montecito, and not only selling us many of the buildings we own, we still own, you guys are tenants in, but also investing in our funds. And over the years, we have about 1,000 physician investors in our medical office real estate funds. And so we really appreciate your support. So Brandy, let's go to the next slide, or Mike. And this slide is the purpose of Montecito. And when you pull back and look at, this is what we wake up in the morning, this is what we think about. How do we take care of physicians? If we can make our physicians, practices, and we help them monetize, help them grow their business or practice, then we're doing great. And in that, the physician funds have come about, many years ago, because it expands our partnership, and we're taking care of physicians because we're making them good money outside their properties that they sold us. So anyway, think about that. That's probably the most important slide. We're going to talk about a lot of slides today, but that's our core purpose. So quickly, I think I met everybody. I saw the list through the years, but I'm going to give you a quick overview of Montecito. So Montecito, since 2006, we've been buying medical office real estate all over the country. We're a private company, and we're headquartered here in Nashville, Tennessee. So if ever you're here in Nashville, please come see our corporate headquarters, meet our great team. So managing team, we really do have some of the best people, I think, in the industry. Our team has bought over 1,000 MOBs through the years. The average tenure of our senior C-suite in medical office, all of our guys are kind of experts. We've been fortunate to be in Nashville, where there's a lot of medical real estate folks. We've kind of hired some of the best in the industry. So I think our team is one of the reasons we have had such great results through the years. And we think will continue to give us a lot of great opportunities. Our track record, over the years, Montecito has bought over 500 MOBs, I think we're up to 5.5 billion, Mike, and you might need to update the slide. And last year, we had a good year. COVID, as you guys know, many of you guys are our tenants. All of our practices did well in terms of paying their rent. We understand it was a tough market, but over the years, being in this market through ups and downs, medical office has always performed for us, and as a sector has been one of the most resilient sectors in real estate. Mike's going to talk about that a little bit further in. And as you guys know, through the years, we have invested. We focused on dominant, successful physician groups and also health systems. And over the years, we've really developed some great relationships and great track records. And so our investment strategies continue to do the same exact thing that we've done for 17 years. And in our business, the medical office business, our buildings are smaller sometimes and medium, and very few are very large. And when you put those into a large portfolio, we've been very successful getting large institutions to pay a lot more than we paid, because they like that big check. They don't want to cut a $5 million check. They like to cut a $200 million check. And so we call that portfolio premium. And we've been very successful. We'll show you the details of that over the years. We also have leveraged through the years. 15 years ago, we bought a research company, Montecito. And then through the years, we've upgraded that and spent a tremendous amount of time and effort. And today, I think we have one of the best proprietary data analysis tools that helps us predict the successful practices that we'll be buying in Fund 4. And we've never had a loser through the years. So I think that data is a big part of how we buy stuff, a big part of our strategy. If you look at Montecito today, we're up to 265 MOBs. We have a 99% occupancy. We have 11-year weighted lease term on all of it together. So we have a very unique portfolio, and it comes back to the strategy that Mike's going to walk you through, and I'll be chiming in, I'm sure. But that's just a little bit about Montecito, and we're very bullish, kind of where we are in the cycle of the market. And we think there's a big opportunity to buy some really great assets at great prices based on the current environment. But Mike, I'm gonna pass it over to you, and you can continue to walk through the presentation.
Thanks, Chip. Excited to be here. Appreciate everybody's time today. And listen, as Chip stated earlier, the physician investors, well, we don't have favorites. There are favorite investors. And Chip and I are on calls like this every week with large foundations, endowments, insurance companies who are all interested in medical office as an asset class. And most of you as physicians will understand these. And so we won't spend a whole lot of time as to why we specifically have focused the last 17 years on medical office properties. So as Chip alluded to earlier, very recession resilient from a fundamental standpoint. As you know, healthcare is the largest part of the U.S. economy and continuing to grow. And so we love those recession resistant fundamentals. We love that it's really demand driven. So if you think about COVID, at that time when it first hit, call it, March of 2020, we owned some properties in states that they may have had to close their doors for 60 or 90 days. That would have never been something you could have modeled in from an investment perspective. And, we worked with these tenants. At that time, I said we owned probably over 125 properties. We went on a listening tour, went out and met with everybody. A couple of them before they knew what PPP looked like, asked for some type of a rent abatement. But what we found is all of them emerged out of it stronger. The demand didn't go away. Some of them may have had to extend their hours. They may have had to do more procedures on the weekends. So again, we love that secular kind of long-term demand growth that we see in healthcare. Another wonderful driver in healthcare is it's not a speculative built commercial real estate asset class. So on a given year, there may be 600 to 700 new properties that come about. And these are really coming through new builds by current physician groups mainly. So one of the things we focus on is that in 37 states, you're required to have a certificate of need through a government agency to actually build a new property. And so one of the things that Montecito has been focused on is as we develop these longstanding relationships with dominant providers who many of them have multiple buildings and they're looking to grow and expand. One of the unique things that we'll have here in this fourth medical office fund is we are going to have some development in this particular fund because we get a lot of questions from these current physician practices saying, can you help us determine where we're going to put our next facility? And so we can use this robust data analytics platform that Chip spoke of earlier to help them target where to place that next facility as they look to grow their practice. Again, a couple more things I'll touch on here. So the industry evolution, we've always focused on off-campus outpatient facilities, and really that continues to be the focus of institutional investors. So it used to be 17 years ago, institutional investors in healthcare real estate would focus more on the healthcare systems and the big on-campus hospitals. Now what you see is, of course, the providers, the physicians, they want to operate closer to their home. The patients themselves, they want to be able to go in and out of an outpatient facility. They don't want to go into a robust 17-story parking deck and try and figure out which wing of the hospital they need to go into. So you always knew that those two wanted to be in an outpatient. But this third leg of the stool that's really driven a lot more business is the payers. So in this day and age, the United Healthcares of the world, the Aetnas of the world, try and push from an incentive or reimbursement standpoint to actually drive the patients to be in an outpatient setting, an off-campus setting. So we love those continued trends, and we'll show you specifically some of the outpatient growth that we're seeing from our resources. From a capital markets standpoint, we're seeing, as Chip and I have conversations with institutional investors, we're seeing about a high level of interest as there's ever been from an institutional investor. So we've sold 9 portfolios over our 17 years, and to some of the biggest names in private equity, the KKRs of the world, the AEWs of the world. AEW is about an $80 billion global real estate firm. KKR, it's tough I may have lost count. I think the number is more like about $500 billion, about 500 billion plus total organization. So some of these largest private equity groups in the world have a keen interest in building out their medical office portfolio. And so, we're excited to create these portfolios that we eventually sell up market to those large institutional buyers. And then lastly, it's still a very, go ahead, Chip.
Like, real quick. And it's global now. Like, we've been approached by the Bank of Bahrain, right? What was it? It was Bank of Bahrain and
Yeah, no, in Oman, yes.
and they want to deploy $1 billion in medical office. The Singapore government, they're big in medical office now. They just bought a huge portfolio. So it's an international market. And when you look at when we went into the business 17 years ago, it wasn't like that. The medical office has become an institutionalized asset class, and it's global. Go ahead, Mike.
That's a great point, Chip. Thank you. And again, I won't spend, because we have a lot of healthcare practitioners here on the call with us, I won't spend much time into some of these demographic trends and the increase in kind of US GDP from a healthcare perspective. You live it and breathe it every day from a physician standpoint. But I do think this one is really interesting for us. So if you think about all these, you have this confluence, as I said, all those drivers to outpatient, and then you add that into the miracles of modern technology to allow, more knee replacements, more hip replacements, even some cardiac procedures to be done outpatient off campus. And we're expecting that growth over the next 10 years to explode even more. You can see here in this chart, knee replacements potentially up 300% over the next 10 years. So again, we think that the drivers continue to push in our favor in where we've spent the last 17 years building medical office buildings and the properties. This is a great example of some of our partners over the years. You can see that we focus a lot on high acuity use specialty practices. So we have relationships with 4 of the 10 largest orthopedic groups in the country, 7 of the 20 largest urology groups. We love the specialty practices that have space for surgery centers. They have space for imaging. They have space for some type of a specialized equipment. Of course, that makes the build out more customized. These tend to be newer buildings. These buildings have to be built to have certain types of electrical capacity. They have to be built to, have the types of safety for, imaging and for the radiation that may be involved in it. So, again, these are specific newer building vintages with dominant physician groups as we target these all across the country.
Hey, Mike, when I look at the logos, I know there's 3 of the top 4 orthopedics groups on this call right now that are our customers. And so, you guys as customers have been amazing with referrals and supporters through the years, Fund 1, Fund 2, Fund 3. So we really appreciate it. And I'm looking at the list here. There's a lot of very dominant providers on this call. So you guys know that story way better than we do. So
it's a great point, Chip. And this really, again, speaks to the strength of that physician relationship. It becomes a wonderful flywheel effect for us, right? So we allow the physicians, when we acquire the property directly from the physician group, to roll proceeds back into the deal. So in some cases, from 10 to as high as 40 or almost 50% will be rolled back into the deal. So the physicians themselves will be invested side by side along with Montecito. And this gives optionality. So all the physicians don't have to agree to do the same thing. You could have some that will take all their proceeds, some that will roll all 100% of the proceeds back in, and then others that will maybe sit somewhere in between. And so that optionality allows us to win a deal. When you have a physician group, as you folks know, to try and sometimes get 30, 40, 50 physicians to all agree to do the same thing is not always that easy. So this optionality for us allows us to win over the physicians and to get the deal for Montecito. Through this reinvestment process, the physicians are actually able to take advantage of IRS tax code 721. Many of you may be familiar with 1031, so it has very similar tenets, allows them to roll proceeds on a tax deferred basis forward. So again, the physicians, we acquire the property from them, they roll proceeds back into the deal itself, and then many of them come into our funds. As Chip alluded to earlier, for Fund 4, we'll probably have over 1,000 physicians in Fund 4. And then from there, we're hopeful that they'll maybe refer us out to other physicians who we could eventually either buy properties from or to invest in our funds as well. So again, it's created a wonderful halo effect for Montecito in a lot of these specialty practices. This talks a little bit more about how we kind of go to market. And as I said, we acquire directly from the physician group. A lot of them roll proceeds back into the deal, creates alignment for us. We get a lot of white coat to white coat referrals, which, as you folks know, is very powerful. Physicians, as you folks know, get called on by people from all different types of businesses. And so their time is very valuable to them. So for us to get a warm referral really helps us, get to a deal as well. When we think about just, overall, the market, Chip had talked earlier about the amount of time and effort and resources we put in data analytics. So we all know it says 62,000 here, but we know it's more like a number about 64,000 medical office properties across the country. We rate and grade every one a scale of 1 to 10. And we look not only at the last 5 years data, but through AI, we're able to be predictive on the next 5 years. So we score every market, we score every practice. Within the practice, we score the physicians themselves, and we grab billing data. We look at referral patterns. And so we're able to be very predictive about kind of the growth of a physician practice itself. It allows us to, in essence, de-risk the investment by using all this data. We take all 64,000, filter it down to the top 3, 4, 5% that we want to focus our efforts on. And that's who we look to build these relationships with. Chip, anything that you want to add there?
Yeah, and then the last thing, which has been really helpful, is we do rate every building. And so out of 62,000, we have about 9,000, we call them our trophy properties. And it's amazing how the analytics, because of all the data we have, can really rate a property very accurately. And with that, it gets our team of 15 people at Montecito source deals and underwrite deals to focus on the ones that are going to be long-term successful practices and long-term successful buildings in that market. So I just wanted to add that, Mike.
No, that's great, Chip. I appreciate that. Again, we're a big believer in data. We're using this data in a lot of unique ways. One of the things that the Montecito platform, the Conks, have continued to invest in is other healthcare SaaS solutions. As our hope is to be a partner with these physician groups long-term, we're looking to find other ways that we can drive efficiencies to their practice through healthcare SaaS solutions in areas such as physician recruiting or even for billing and coding. Love to talk to any of you physician groups about these other avenues that we're pursuing efficiencies and investments in healthcare SaaS solutions to help with practice management. Chip and I are always available to discuss those at any time.
And we have a team of folks that handle that, guys. And I know some of the groups on the phone, they're in discussion or have signed up to use some of our SaaS product that sits on top of this massive database. And it's been really helpful to help you guys grow.
Thanks, Chip. So this is one of my favorite slides to brag upon our track record here and the great company that Conks have built. Again, we've been able to average through our 9 portfolio sales almost a 26% gross IRR. And so, if you stack those up in any given period of time in which those portfolios that were owned, and you can compare it against the S&P 500, you can compare it against the NASDAQ. More pertinently, probably makes sense to compare it against the NAREIT, so the real estate index, and you can see what type of outperformance that Montecito has had in various time periods, whether that be during a recession or a time of growth or the pandemic itself. So again, we stand by this terrific track record and our ability to kind of deliver high-level returns to our physician investors. I won't spend a whole lot of time on portfolio cap rates, and the easiest way for you folks who may not be familiar with the concept of capitalization rates in real estate is you could think of it like the yield that a bond pays. So if you buy a property at X price and it's throwing off so much of cash flow to you, that's going to be your yield. So the yields, if you want to look at it from that perspective, so what you'll see in this chart is the consistency of the institutional investors from an acquisition standpoint. So over the last 5 years, there's been 42 portfolio sales. Again, some of those have been Montecito portfolios. And over that time period, that same time period, we've acquired about 150 plus properties. But what you'll see is that irrespective of either where interest rates are, which is the gray line, or where cash yields are, which is the blue line, there's a very tight band for the cap rates. And that just shows you that strength of the institutional asset class and the institutional buyers. Again, just to more finitely look at just a more recent time period of, say, the last 12 months, still a very tight band of institutional interest from those large buyers. Montecito, actually, in our Fund 2, we sold a wonderful sub-portfolio of about 16 properties to a group called Remedy at the end of last year. That closed over November and December. We had a gross IRR return for our investors of 25%. Again, so it was a terrific exit, especially demonstrating the resiliency of the asset class in kind of the uncertain economic times.
And Mike, there's just one other thing I want to add. Because of the environment we're in, where commercial office is doing tough, and it's just very, very hard times for commercial real estate. We've never seen more money trying to come after us to buy the stuff we own. I mean, we've been, not only the Middle Eastern big buyers want to buy big portfolios from us, but we're currently under contract with 5 buildings to sell. We just sold one at a 5.5 cap. 1031 buyers are coming in and saying, "Hey, I was on your website. Well, I'll pay you this price for a single asset." So this asset class has resiliency, and we think we can buy better than we've ever bought based on the market, and there's not as much competition to buy. And we think when interest rates go down, but even in this environment, there's a huge yield difference from what we can buy at that we're buying. We're going to show you one case study, I think, in this book. And what we could literally turn around and sell it for today if it was broadly marketed and the institutional guys went in and bought it. So just wanted to add that. We're seeing it. We really have seen it through. An example would be during the Great Recession, when Lehman filed bankruptcy, we sold a portfolio at an incredibly low cap rate because institutional investors wanted a flight to safety. And pension funds have to invest every year. They have money they have to put out. So a lot of the investors are saying, where would we want to put our money? And, we're seeing a lot of money still going into apartments, a lot of money in the US, a lot of money going into medical and industrial. The other asset classes are money's going out of them, and where are they going to go? Medical office, I think, will continue to get that capital.
That's a great point, Chip. So this current slide just demonstrates, again, that portfolio premium that we see, right? So the institutional buyers, they can't go and buy a property for 10 million, 15 million, 20 million. They got a lot of those large groups like a KKR, AEW have to be able to write checks for hundreds of millions. And so they're paying us a portfolio premium, to buy this aggregate portfolio that we've created through these off-market transactions. Just briefly, we're going to go through a couple of quick case studies on Fund 1 and Fund 2. So Fund 1, we sold in 2021. Again, terrific portfolio that we sold to AEW. Purchase price there, you can see it was about 147 million, and we sold it for almost 190 million. The statistics from a return perspective, 38% gross IRR and a 1.73 gross equity multiple to our investors. So again, out of those investors, almost 100% of those proceeds actually rolled into Fund 3. So many of these investors think of this as this is their exposure, almost like a bond ladder to the commercial real estate asset class for medical office. So as we distribute funds for, say, Fund 1 or even now Fund 2, a lot of them choose to kind of roll that back forward into the next fund. Unfortunately, you can't do a 1031 exchange to that, so it is a taxable event. But again, we know that we're going to deliver that same great return to the investors. The second case study, again, partial sale of Fund 2, I already alluded to the great return that we had on that. So Chip, I don't know if you wanted to add anything else here for this Fund 2 partial sale.
No, I think it's right at the peak of when interest rates were high last year, and we had a very large institutional investor that came in, they all cash buyer, and they said, "Well, we want to invest 140 million," and they made an offer, and then we took it out and tried to get someone to pay us more, but it ended up closing with that buyer. So just again shows you the resiliency of the asset class.
Yeah, it was a great transaction. We actually have of the 16 remaining assets, 15 remaining assets. I believe we have 6 under contract to sell here in the next handful of months, and then the remaining 9 we expect to potentially be sold here before the end of the year. So, again, due to that high institutional demand. This just shows specifically for that Fund 2 sub-portfolio sale, again, kind of that gross IRR metrics, versus what our competitors or what other indices returned.
And I think this is like a great slide to show what I've been saying. And Mike, go back one real quick.
Yep.
So this Ernst & Young came in and looked at all of our sales, and they put these slides together for us. But if you look at the market low, out of all these guys on the right, all these big smart investors, brilliant, Wall Street, and The low of that group was 11.9. The high was 7.2 during the same period when we started buying May of 2020, and when we stopped buying. That is the returns of those individual folks. And if you look at to the far left, we delivered same time, similar assets, but we do it different, a 25% IRR. So it's extraordinarily better. And it's really because of our model and our ability to see so much coming in and be able to redo leases, everything we talked about, our ability to get deals and package them and all that. So I think that's a great slide, Mike. Just wanted to bring up the highlights of it.
No, great point, Chip. Chip, did you want to talk about this case study for this deal, this great deal that we bought at the end of last year?
Yeah, this is great. This is another example. Fund 3, we look at, guys, we get over $1 billion a month coming in. So last year we got, no, it's 2 billion, it's 25 billion, there's 12 months, that's 2 billion a month coming into Montecito. Even on our website, we get a deal a day where an owner or a doctor group will just send us their deal, say, we'd like to talk to you about buying our deal. We heard from you from another doctor, blah, blah, blah. This deal came in South Carolina, Columbia. It's with a very large oncology group, a very dominant group that has a partnership with MUSC, with Roper, Prism, not Roper, Prism. And it's high acuity cancer center. They have like 3 oncology vaults, Class A, very, very successful practice. That deal came into us like on the 5th of November. They said we have to close by the end of the year. We have a financing. The owner was a large New York REIT that had to have a sale posted. Came right to us. We did an off-market transaction at a 6.65 cap rate. Now I'm going to go to the next slide. What does that mean, 6.65, and why is that such a great number? Well, a building, these are all comps of what sold, last year in late 21. But a building in the same market, South Carolina, closed 1 month earlier at a 5 cap. And that was an ortho deal. Actually, it was Prism Ortho. I know there's a bunch of orthopedics on the phone. But that deal was a nice deal. But you can look at the difference in pricing. If you took our asset at a 5 cap versus a 6.65, it's like 20%. We just create 20% value. Then there's other comps on here that talk about there's a cancer deal that traded late last year in Spokane, Washington at a 5 cap. So my point is that our strategy of being very disciplined, of having relationships, the reason we got this deal is Oncology One, the CEO of Oncology One and Tennessee Oncology, very, very close to Montecito. He got on the phone with the owner, the head doctor, said Montecito will close, they can close in 6 weeks. And then that started a very warm conversation. It's not about can you close, it's can you do it in 6 weeks? And we closed it in 6 weeks. And I think we made investors in Fund 3 a tremendous return. So that's just an example of a case study of how we delivered a 25% IRR. There's hundreds of stories like that happen. Hopefully will continue like they have.
Great. Thanks, Chip. And I'm going to talk now just through some of the basic investment terms and objectives for Fund 4. Again, Fund 3 that we closed in 2021 was a $307 million fund. This fund could be similar size. It could be as much as 500 million. We're looking to potentially raise some institutional capital alongside of our physician investors and high net worth investors. But our targets for Fund 4 are going to be a 6 to 8% annual cash on cash yield. And so the fund is designed to throw off monthly cash flow to our investors. So out of all the combined net operating income of all the properties that we own in Fund 4, we're going to try and push out as much of that cash flow out to our investors on a monthly basis as we can. The net return target, again, net return after all fees of 13 to 15%. If you look at our historical track record, we able to deliver well above that. But from an underwriting perspective, this is what we target for our funds when we go look to acquire properties, to be able to deliver to our investors net return of kind of mid to high teens. From a leverage perspective, we look to put on anywhere between 60 to 65% senior leverage. One of the wonderful things about this asset class currently, compared to some other commercial real estate asset classes, is the banks are definitely open for business. So we're able to get all the financing without having any issues compared to some other particular asset classes that may have more troubles kind of getting their full financing. I mentioned before development, so we are going to have a component up to 15% of the fund that's development. And then the rest of this is really the core tenets of Montecito as far as dominant physician practices, high acuity use, specialty practices. Most of those pieces that are core to our business model. From the terms perspective, Fund 4 looks exactly the same as Funds 1 through 3. And so we're targeting, it's here, I know it says 150 to 200 million. From a fee perspective, we charge a 1% one-time acquisition fee. And then we charge a 50 basis points or 0.5% annual asset management fee on the properties that we acquire. The minimum investment has been historically 100,000. We do make some exceptions for our physician investments, physician investors, because they're so important to us. From a contribution perspective, about 90% of the capital will be, again, physicians, physician investors, high net worth families, family offices, institutions, but as much as 10% is going to be Montecito. So the owners, the employees, will all be invested side by side against the physician investors. And then we do, similar to most other private equity funds, have a promote or a profit sharing upon hitting certain waterfall metrics of an IRR return. So I've covered most of the primary tenets. Chip, we're planning to be, currently in the market for Fund 4. The thought is that we would plan to have our first close, call it middle summer, maybe June, July, and then start putting the capital to work shortly after that. And, the expectation is that depending on the size of the fund, could take us anywhere from 18 to 24 months to put all that capital to work.
And it's important to know that the capital, we don't want your capital until we're closing. So we call the capital. If you put in, as you guys probably all know this, I'm saying something you guys all know, but anyway, that's how it's structured. If you commit to a capital commitment, if it's 100,000, it will be over a year to 18 months, maybe 2 years, right? I think we've averaged about 14 months, really.
Yes.
So.
Well, great. I think we covered most of the primary topics, Chip. And so, Brandy, if you want to field some questions for us from the audience.
We have a few questions here. If you're ready, one question that I'll throw to Mike is, what is the exit timeline on average for each fund?
Yeah, so normally, for us, it's a short, when I think of a traditional real estate private equity, the hold period can be anywhere from 7 to 10 years. For us, it's usually a shorter hold period, maybe more like 2 to 5 years. So that, of course, whatever the investment period is, so if it takes us 18 to 24 months, past that, we'll want to own the property for usually 12 months to get it into capital gains territory. So from that perspective, we're probably looking at least a 3 to 5 year hold before we consider, selling assets to the institutional investors.
Okay, thank you.
One of the other things I'll mention as we think about distributing the cash flow to investors is that we do cost segregation and accelerated depreciation. So this is going to be K1 income. And so, you'll have some heavy losses there in the first couple of years. You'll be able to bank those losses. And then when we sell the portfolio, you'll be able to use those losses to offset the gains at the end. So of course, you and your tax accountant can choose if you wanted to use those passive losses against, passive gains that you have in the current year. You're welcome to do that. And there's a lot of ways that you can perform kind of tax strategies on that K1 income. That's another thing I think that is worth mentioning. It's tax advantage income that you're receiving from the investment.
That's a good point. Awesome. All right. Next question. I think I'll throw this out to both of you. What is a unique investor question you get frequently?
You mean take that, Chip?
Yeah, I have one too. Let's see what you say.
Okay. So one of the things and we don't get it as much this year, but last year I felt like we got more questions on telemedicine, and a lot of you physicians have seen kind of telemedicine ramp up, and then maybe in some respects kind of ramp down. So we think a lot of times the telemedicine has been additive to primary care, but part of the reason we focus on high acuity use practices is that we feel that telemedicine can be additive to the business, but it's not going to significantly change their business model. So they're still going to have a certain amount of commercial real estate square footage. They're still going to have space for surgery centers and imaging and all those things that kind of go along, with the preparation potentially for a surgery or a procedure. So I think that telemedicine question is a little bit unique is something that I've gotten here over the last couple of years. How about you, Chip?
I think it's more the most recent questions is why buy real estate now? Why not wait? What, you know, we're hearing we listen to the news every day. We hear negative about the commercial real estate business. And I've never seen a better time for our sector, meaning, you know, but like the cancer deal at a 6.65, if it was a normal market and, you know, they would have, if they would have probably taken it to a broker, if they ended up closing in 6 weeks, that would have cost us 20 million more. And so we see this stuff every day. So what we're managing is the cap rate we're buying it at. We're extending the one, it's got to be the right practice, right? You guys are dominant practice, dominant market, great market. And then we're going to manage what can we pay for it? And because we have $2 billion a month coming in, we're saying, and we're working, you know, with these practices, and they want to have a monetizing event for partners retiring or whatever, buy a new building, or we're really managing what we buy it at. So today we're buying assets that I never thought we could buy at cap rates that we're buying them at. And I have seen this many times through the years, you know, when interest rates go up, when they go back down, I think we'll have a great exit. So the question I get is why buy now? And that's my answer, is I think it's a wonderful time to buy if you're disciplined and you have a process and you have a relation, if you understand the sector and you have capital. So that's what I get, Mike, a lot now. But a lot of our investors are super excited about Fund 4, and we've gotten some really good commitments about coming into it. So what other
Thanks,
questions?
I have another question here. Can you explain what sponsored GP means in your fee slide?
Sure, I can take that one. So when any private equity fund, you usually have a general partner who's going to be the manager, and then you have a limited partner who's going to be the investors. So in this case, the general partner would be Montecito. So the investments that Montecito is making, meaning that the Conk family and other members of management they're investing are through the general partner versus a limited partner. Now, what is unique is that actually most of our general partner shares are in limited partner shares. So, and from that perspective, that 10%, 9.8% of that, of the 10%, you know, over 90% of that amount is actually through limited partner shares, not through general partner shares. So hopefully that gives you an idea of the difference between general partner, which again is the sponsor themselves, the company, and the limited partner, which is the investors.
Thanks, Mike. We have one more question, which is, it's a good question to close with. What are the logistics of signing up to become an investor with Montecito?
Wonderful. So again, we've provided you the information here for this presentation. You know, we'll follow up and get you a copy of the presentation. The next step for our investors would be able to have access to our investor portal. So we use a company called IMS as our investor portal. So for anyone who's interested in accessing our documents and reviewing them, we create a login for them. They go into IMS and they're able to review all the documents, and they can actually electronically execute everything in IMS. And then the premise of IMS is then it serves as our investor portal. So once they've executed the documents, they can use IMS to log in to check, you know, whatever the cash flows are. If there was a capital call or if there was a distribution, they can be able to see kind of the cash flows of the investment. They can look and track potentially the properties that would be owned in the investment. And then we also, you know, send out other investor communications via IMS, whether it be for a capital call or a distribution, or we send a quarterly newsletter. So both Chip and Brandy are heavily involved in the creation of the quarterly newsletter that we send out to our investors to kind of give them, you know, our high level view of the market, and then specifically to talk about that specific fund, whether it be Fund 3 or in this case, Fund 4.
Awesome. Thanks,
Anything
Mike.
that I left out there, Chip?
No, you did great. Good.
That's all we have for questions, Mike.
Wonderful. Chip, do you want to close us out? I'll say thank you real quick to everybody for joining, but go ahead and close us out, Chip.
Yeah, and we're available if any follow-up conversations. You guys, a lot of y'all have my email. If not, you can get it's chipconk@montecitomac.com, and Mike's always available, Melissa. But we're here for you guys. Any questions you have, and we're excited about this fund and continue to expand our relationship. So thanks for your time tonight. I know some of you guys are on the East Coast. It's probably dinner time, so we're gonna let you guys head back to work or go have a dinner.
All right. Thanks, guys.
Thank you.
Guys.
Bye.